The recent yield curve inversion has renewed speculation about a North American recession. Meanwhile, indicators suggest that the next recession may hit Canadians harder than Americans. For more, let's bring in Eric Lascelles, RBC Global Asset Management Chief Economist. Thanks so much for being with us.
Thank you.
And your view really hinges on two things: housing and debt. And that's something that Canada has got in spades relative to the U.S. right now.
Well, that is precisely it. And really, you can almost think of it as Canada getting away scot-free last recession with a housing market that held together and ultimately kept on growing. And here we are a decade later with quite a tame U.S. housing market, not particularly vulnerable, even if there were to be some sort of North American or global economic downturn, but a Canadian one that is now a big part of GDP. Affordability, of course, that's not so good, and household debt levels that are quite high. And I don't think it's particularly the case that housing is likely to lead. It's not obvious that Canada is going to have a recession that's housing driven, but to the extent we could find ourselves at some point in a recession, that would be the logical time for some of those pressures to abate from an affordability and a housing perspective more broadly.
Eric, so let's get the comparison between Canada and the U.S. when it comes to household savings rate. We saw Canada's household savings rate falling to 1.1% in the first quarter. Now, compare that to the U.S. around 6.7%. So are you implying that there could be a debt crisis in the making in Canada, and how much buffer does Canada have against the U.S.?
Yeah, I'd stop short of saying debt crisis, but I certainly would say softness in the consumer base on the basis of how much debt they've built up. And so, as you mentioned, Canadians not saving a lot, so not a huge buffer here in the event that they do suddenly find themselves with a higher unemployment rate, whereas Americans have some wiggle room there. When you look at household debt, of course, debt-to-income ratios, record highs here in Canada, almost 180% of income, and the U.S. sitting down several tens of percentage points lower than that. And again, nothing suggesting disaster right now, but all of that adds up to a diminished ability to spend and a greater vulnerability should the world suddenly encounter higher unemployment rates. That's a more consequential thing for Canada.
Now, in 2015, Canada experienced a recession. It was mild and largely driven by the crash that we'd seen in oil prices. And yet, even though housing was elevated then and so were household debt levels, it proved to be very mild and the Canadian economy bounced back. Why do you think the next recession will play out differently for Canadians?
Right. Well, keep in mind a few things. One would be, of course, because it was an oil shock that was disproportionately in Alberta, perhaps a bit of Saskatchewan and a bit of Newfoundland story. And if you look at the Alberta housing market, actually, those home prices have been falling ever since, and there has been some amount of suffering going on there. So I would say that was a regional experience, and conceivably a national one could have more national consequences. And so that's probably the big answer as it stands right now. I guess looking maybe to some extent beyond that, again, the point isn't so much that there's this enormous vulnerability at this moment. Actually, the best gauge of debt crises is how much debt have you accumulated recently, and Canadians have thankfully pulled off the gas a little bit on that recently. It is still the case, though, that you just don't have that wiggle room on the consumer. You have a lot of household debt. The affordability is stretched, and really, we've estimated, maybe generously, that 22% of the Canadian economy is housing. That is several percentage points more than normal, several percentage points more than the U.S. It's given us an artificial tailwind maybe we didn't fully appreciate over the last 15 years, and at some point we might need to give a bit of that back, and when would be more natural than a recession.
Talking about the tailwind, how much of a tailwind could a weaker Canadian dollar be if in a recession you get commodity prices also falling?
Right. Well, I mean, these are good questions you're asking, and so it's fair to make a couple of points. One, on the negative side, historically, commodity prices fall during recessions, and that's another way perhaps a country like Canada gets hit. However, equally, let's acknowledge there is room for the Bank of Canada to cut rates. Maybe there's even more room for fiscal stimulus than in the U.S., and so on a number of fronts, and the currency generally softens as well. So let's not pretend there are no solutions here, and I'm sure all of the various levers will be pulled as appropriate, but you still have this big housing market that could take that opportunity to cool, and I feel like that dominates everything else, including what could be a weaker Canadian dollar.
Eric, thank you so much for your time. Eric Lascelles, RBC Global Asset Management Chief Economist.